India's economy raced ahead of all expectations last year. Data released this evening showed a 7.2% GDP growth rate in 22-23, 20 basis points. Economy raced ahead of all expectations last year. Data released this evening showed a 7.2% GDP growth rate in 22-23, 20 basis points higher than the RBI's earlier estimates of 7%. Though the figure is lower than last year, it puts India on top of other nations, especially the West, which is threatened by an economic slowdown. The figure is also way higher than 3% which China reported in 2022. There was some good news in the Jan to March quarter as well, with GDP growth clocking in at 6.1%. Importantly, the quarter witnessed a substantial rise in manufacturing and construction activity, setting the stage for the next few months.
Services sector growth has maintained its momentum. Industrial sector growth rate positive but slowing compared to 22 because of the rise in commodity prices in the course of 22-23 and also the rise in interest rates. But the momentum in the fourth quarter, as you could see from the data, in terms of manufacturing growth was at 4.5%, and the utility and the core sectors grew 6.9%. So overall, the manufacturing sector has ended its 2 quarters of year-on-year contraction in Q2 and Q3 and resumed a pretty brisk positive growth rate in Q4. Exports of goods and services as a percentage of GDP, as you can see from the top right, is at its highest in about 8 years at 23.5% of GDP.
I earlier discussed the GDP numbers with Madan Sabnavis, Chief Economist, Bank of Baroda, and Aditi Nayar, Chief Economist, ICRA. Here's an excerpt. Go ahead, Madan.
Yeah, I think it's come in much better than what we had expected, 7.2%.
Yeah.
And I think that's a very comforting number, though that will also mean that when we are making any forecasts for 23-24, they would get tempered to that extent. And from the numbers which I'm able to see, it looks like that this higher number has come because of better performance of the agricultural sector, which was compared to their earlier estimate, and followed also by mining and then the services sector. The only disappointment as it looks to be the manufacturing sector, which was supposed to be 1.6% earlier, but now it appears to be 1.3%. So I think otherwise it's more or less in tune with what was told to us in the month of March.
Okay, it's a pretty good number actually. Aditi, let me get your take as well.
No, definitely better than what we were expecting. So that's comforting, as Madan said. And going ahead, as far as the current year is concerned, we've got our baseline expectation is that GDP growth will be about 6%. And we're looking at an upside and looking at a downside. The upside is if the government infrastructure and capital spending really kicks off fast. Today's fiscal data from Government of India doesn't necessarily support that, because we did end up having a lot of excess rain in April, which was obviously not very helpful. But we're looking at an upside of 50 basis points from a quicker kickoff of the CapEx program. And we're looking at a downside of about 50 basis points if the monsoon does turn out to be subpar and the El Nino has a more intense impact than what perhaps we may be building in at this point in time.
Aditi, what do you feel are going to be some of the major drivers going forward now? Yes, we haven't seen private capex pick up so much, but we are definitely seeing several other pockets of the economy really contributing.
So as far as Q4 is concerned, the positive surprises come in on account of most of the industrial sectors, manufacturing, construction, and also agriculture to some extent have done better than what we had penciled in. And this is really what has led to the overall number coming in at 7.2% instead of the 7% that the NSO had indicated in the second advanced estimates. Now going ahead, I do believe that we're in for another year of uneven growth. Whether we look at the sectoral side, I do think that services sector will continue to outpace industry and agriculture. Of course, we need to see what kind of a monsoon we finally end up with, and whether things like the healthy reservoir levels can actually mitigate any negative impact of a slight delay in the monsoon onset, or specifically in terms of an El Nino in the second half of the year of the monsoon season. But with on the expenditure side again, I do think that private consumption on the whole is likely to remain healthy, but it's likely to still be quite uneven next year as well. And government capex, we're hoping will do a lot of the heavy lifting and encourage a faster pickup in the private capex cycle as well. We're not expecting exports to do too well in the global scenario, but that's likely to be one of the big headwinds going ahead.
All right. We also, of course, have been seeing some green shoots in terms of capital flows coming back as well. So some kind of investment picking up there. Madan, are you seeing any silver lining on that front? Are you still concerned about the overall global picture and whether or not we'll be relatively insulated there?
The thing is that India is basically a domestic-oriented economy. So to that extent, in case there is a significant slowdown in the global economy, we are talking today of a recession in countries like Germany and UK. We are seeing negative growth rates. That's not really something which is going to impact us because we're not that dependent on exports, unlike some of the Southeast Asian economies. However, but any kind of a slowdown in the Western economies also will mean that it will affect the flow of capital. And we've already seen last year that the FDI numbers have come in lower than what we were. We normally took 80 million for granted, and this time we did not get that $80 billion. One is, of course, the moment you have quantitative tightening, there's a smaller set of funds which are available for investment in emerging markets. And the second part is, I think we also saw a bit of disinvestment taking place in the sense that some of the FDI was actually moving out of the country, probably those invested in startups, but the performance has not been as reassuring as what was expected. So I think the concern will be more in terms of the flow of funds on account of the global slowdown rather than the direct impact on our GDP. There will be some impact, so therefore we're looking at lower growth in 24 compared to 23, but it's going to be more significant, more in terms of the capital flows, is what I feel.
We're heading into, of course, a countdown to election year, and I'm just wondering whether you feel we're going to continue to see a bigger push when it comes to some of these pockets. Are we going to see sustained impact of the kind of jump we've seen on the construction and mining pockets?
Certainly, I mean, when we look at the number of government projects where 80% of the total spend had already been completed by end of March and looking like, we're heading into an election year, I certainly think there will be a big push to actually complete those projects, and that should be quite positive for the momentum going ahead. And added to that, both the central government and the state governments have put a lot of money on the table for capex. So how quickly does that take off? I mean, how efficient is the execution in terms of being able to take care of the outlays? That's really what they're waiting to see.
Global concerns receding, it seems that the attention may now shift to growth, or will the government continue to be a little constrained?
I think that something like employment is generated as economies progress. I don't think there's anything much which can be done. I think the government has given employment letters to several people, so I think that's a more direct way of creating jobs. But I think what we really need to see is the manufacturing sector revive, because we need to see more productive jobs coming through. Today, if you look at employment, where exactly are we generating it? We're generating in the construction sector, that would be the blue-collar laborers. We're doing it a lot in terms of services when it comes to delivery boys, e-commerce, these kind of areas. But I don't think they really give you the kind of sustainable income, something which can keep the consumption clock ticking.